Alrighty, everybody. Welcome and thank you all again for coming to Financial Planning Day. Right now, we're going to have an amazing presentation by Larry Pon regarding the One Big Beautiful Bill Act and what 2025 tax reform means to you. The One Big Beautiful Bill is now the new tax law. What is it going to mean to you guys? How is it going to affect you? Some of the provisions of this new tax law take into effect in 2025, but many will start in 2026. Over this talk today, we're going to review the changes that will affect your tax bill and if there are some financial moves that might benefit you that you can make right now. Mr. Pon is a certified public accountant, personal finance specialist, certified financial planner, enrolled agent, U.S. tax court practitioner, and accredited estate planner in Redwood Shores. He's been in practice since 1986 and speaks regularly nationwide on tax planning and financial planning topics to both tax professionals and financial advisors. Mr. Pon received his bachelor's in business administration with an emphasis in accounting and finance from UC Berkeley and a master's in taxation from Golden Gate University in San Francisco. Please welcome Mr. Pon.
Thank you, Robert. Good afternoon, everybody. We're going to talk about the One Big Beautiful Bill. And if you have questions, write them down, hold it to the end, because we have a lot to go over. So I'm going to try to end it around 2 o'clock. Gives us about 15 minutes for Q&A. So hold on to your questions, write them down, and then we'll go over them at that time. So let's talk about what we're going to cover today. So we're going to talk about the One Big Beautiful Bill. How did we get there, and what's the background behind that? Then we're going to go over the individual provisions, which is the big chunk of the law. What changes on individual taxes, and then business provisions, that changes for what the business, as a business owner, you can take advantage of. And of course, the new tax provisions that you've been hearing a lot about recently. And then we'll end with what's next. What's the next thing to look out for? So let's get started with the One Big Beautiful Bill. We actually have to go back in time. We have to go back to December 22nd, 2017. That's when we got what's called the Tax Cut and Jobs Act. And that was a pretty significant tax law change. Biggest tax law change since 1986. That's what gave us the Internal Revenue Code of 1986. That's the name of the tax law. It's still called the Internal Revenue Code of 1986. We went through some significant changes then where taxes were cut, and then taxes were cut further with the Tax Cut and Jobs Act. Now, a little bit of background of how tax laws get passed. The Tax Cut and Jobs Act was passed under a process called budget reconciliation. So if you hear that in the news, you hear the word reconciliation, that's what that's all about. What does that mean? To pass the law, you only need a simple majority. And we've been seeing a lot of simple majorities. Otherwise, it needs to be passed with 60 votes in the Senate. You're seeing that in the news today, right? Where the Congress can't vote on the budget, which is why we have a shutdown. We have a shutdown right now. It's going on, and let's hope our Congress members can do their job. We hired them for one job, right? So encourage them to do their job, pass the budget. We're late. It's what today? What's today? October 17th? 18th? 18th, right? So, and the fiscal year ended on September 30th. So we're still in a government shutdown, which is affecting all of us, especially of us tax people. So that's what Congress needs to do. And it's called the One Big Beautiful Bill because after November of 2024, the House and the Senate has Republican majorities, small majorities, and the White House has a Republican president. So it's all one party. And in the last few years, there's been multiple bills introduced, hundreds of bills introduced. So they put it together as the One Big Beautiful Bill. Well, the Tax Cut and Jobs Act was passed under budget reconciliation. So what that means is it's not permanent. It expires on December 31st of 2025. So what would happen if that law didn't get extended? We'd see tax increases, a lower estate tax exemption, and basically the opposite of what we saw in 2018. When taxes went down, taxes will go up. Well, because of the political situation, Congress put all those bills together and put together the one big, beautiful bill. And so where does tax law start? From our civics classes in high school, it starts in the House of Representatives. It starts in the House Ways and Means Committee. That's where tax laws start. Past that, and then through much debate, we saw that in the news, eventually the House of Representatives voted for the bill. The actual bill itself is 1,200 pages. It passed 215 to 214. So simple majority there. Basically, all the Democrats voted no. 2 Republicans voted no. 1 voted present, and 1 was asleep. He missed his vote because he was asleep in his chair and he missed his vote. But anyway, it was enough for it to pass. So it passed the House of Representatives. We got a bill. Then it went across the Capitol to the Senate. And the committee that writes the tax laws in the Senate is the Senate Finance Committee. So they passed the bill, so it can go to the whole Senate. But the first stop was the Senate parliamentarian. Her name is Elizabeth McDonald. Her job is to go line by line on this bill here to see if it meets budget reconciliation. So there were many parts of the bill that had nothing to do with the budget, so she got it down from about 1,200 pages down to 887 pages. Then it went to the Senate for a vote, and then in the Senate they have something called a votorama, which means all the senators had their ideas of amendments to the bill. Chuck Schumer, the Senate Majority Leader, says, I think we should read the bill. So he had the Senate clerks read the bill, all 940 pages of it. It took them 16 hours to read the bill. So there we go. July 1st, they had a marathon session, went through the night, and it ended up being 50-50. So all the Democrats said no, and 3 Republicans said no, so it ended up 50-50. The president of the Senate is the vice president, so he cast a tie-breaking vote. So it passed the Senate with many changes to the House version of the bill. So passed the Senate, went back to the other side to the House on July 2nd. And the House could either just vote on the bill they got from the Senate, or they made their own changes, made more changes. If they made any changes, it would have started all over again. And they passed it the way the Senate made the changes. And we'll talk about those changes in a second here. So they didn't make any changes to the Senate version of the bill. And let's see, all the Democrats voted no. Hakeem Jeffries, the House Minority Leader, spoke against the bill. He didn't agree with it. He talked for 8 hours and 44 minutes without a restroom break. And then 2 Republicans voted no, but that was enough votes, 218 to 214, to pass the law. So now we have a law. It went a few blocks to the White House for signature on July the 4th. The president signed it at the South Lawn. These are usually signed in the Rose Garden, but have you seen the Rose Garden? It's been paved over, so there's no Rose Garden. So it's in the South Lawn with a party. We have a B-2 bomber flyover, fighter jets, and fireworks. So July 4th of this year, the One Big Beautiful has been passed. It's made into law. There's multiple names. It's also known as HR1, also known as, some people call it OB3. The technical name is Public Law 119-21. 119 stands for the Congress. We're in the 119th Congress. So whatever you call it, we've got this law, and we're going to go over all the changes that affects all of us. So let's start with the individual side of things here. So what the One Big Beautiful Bill did was extend the Tax and Jobs Act. So the taxes are not going up, retaining the same brackets and the same rates. So, we have the 7 tax brackets, 10, 12, 22, 24, 32, 35, with 37% being the top tax bracket. So no tax increase. So if you look at these numbers, we're at historically low rates, right? In history, this is the lowest we've ever seen in taxes. So we're living under these kind of rates. The Joint Committee of Taxation did some estimates of what the tax rates would look like if the law didn't pass. And if you look really carefully, you notice the top bracket is, oops, I have it here. I thought I had it here. The top rate would have been 39.6%, bringing that top rate back again. So we just got the announcement this week from the IRS of what the new 26 rates are going to look like. So, These are the tables. So, we hear in the news about, or social media about, oh, our taxes are going up, our taxes are going down, our taxes aren't changing. Well, the official answer is that it depends, right? The tax calculation is quite complicated. It depends on your source of income, it depends on what type of income you have, and those sorts of things. So it's really hard to make this simple statement that everyone's taxes are going up or everyone's taxes are going down. So here I ran some numbers. You can do this all day long. I wanted to see what the difference was if the Tax on Jobs Act was not extended versus it being extended. So, and I used the top of the 35% bracket. And you can plug in your own numbers to see what it would do. So for example, if you're single, looks like there's not that much of a difference, only $800. If you're married, with the extension of the Tax on Jobs Act, the taxes are actually $20,000 lower. So what that means is, if the Tax on Jobs Act was allowed to expire, if you're married in the 35% bracket, your taxes are going up by $20,000. Or if you're head of household, it looks like your taxes would go up by $3,800 with the extension of the Tax on Jobs Act. So everyone's situation is a little bit different. So you have to look at your own situation when it comes to seeing, is my taxes going up or down? So it's really going to depend, right? Okay. Capital gains. The capital gains are taxed at three rates, either 0%, 15%, or 20%. And you get capital gains rates on your assets if you hold them for at least a year. You hold them for less than a year, it's taxed as ordinary income. So let's take a look at this table here. So these are the capital gains rates. And it's based on your taxable income. So look on the left-hand side here, the 0% rate. So let's look at our married, filing joint people who are married. If you notice, you pay 0% on your long-term capital gains and your qualified dividends if your taxable income is less than $96,700. So that's 0%. But look at the 15% rate. Look how wide that is. Starts at 96 all the way to $600,000. So if you got to sell something with a gain, sell it real estate, stocks, or whatever, you can be paying the 15% rate. And of course, if you have a large amount of income, then of course you hit the 20% rate. So this is for capital gains taxes. Now there's other taxes to consider too. So if you're married and your income's over $250,000, on top of that you pay a 3.8% net investment income tax surcharge. So, when you do tax planning, it's not just one number times another number. It's multiple numbers depending on your sources of income. So the good news is we know what the tax rates are going to look like in the future. I don't know about you. I've been having some anxiety for the last couple of years because we didn't know what's going to happen in 26. Doesn't mean our taxes are going up, but now we have some certainty. So because of this, it can help us with our tax planning. So now that we have certainty of future tax rates, we know what they're going to look like. So we can plan accordingly. If I need to sell some securities, I want to sell real estate or something like that, I will know what the costs are going to be instead of just a big question mark. A very popular financial planning strategy are doing what's called Roth conversions. You got to be really careful about that. And we'll talk about that some more a little later because there's more variables to consider. So what's the advantage of a Roth IRA? The advantage of a Roth IRA is that it's not subject to required minimum distributions, and also it's tax-free if you take money out of it, subject to certain conditions. Also, if you leave it for your beneficiaries, they pay no income tax on the Roth IRA. So those are some advantages of the Roth IRA, and that's why we might want to do some conversions, but we got to understand what the costs are before we do any conversion. And of course, taking advantage of that 0% rate. Who likes paying 0% taxes, right? So I'm a big fan of that. So maybe some strategy could be realizing capital gains in your portfolio. Take a look at your portfolio. What can I sell and still pay 0% taxes? So that's a pretty good thing to consider. We're going to hold the questions to the end. Write it down, so we'll give it to the end. Okay, and then for planning, we're going to focus on strategies that reduce the above-the-line income. So that's some strategies we need to take a look at and what we can do. And that's usually the items you see on page 2 of Schedule 1. Okay. All right, so we talked about your tax rates and brackets, Capital gains, let's talk about the standard deduction. So the standard deduction got a little bit of an increase from what we learned earlier this year, and they bumped it up a little bit. It was $15,000 for single, $30,000 for married filing jointly, but for some reason Congress decided to bump it up a little bit. So it's $15,750 for singles, $31,500 for married filing jointly, and $23,625 for head of household. So the Tax and Jobs Act doubled the standard deduction, which means most of us are not itemizing. We're taking the standard deduction. So what does this mean? Well, let's say you're married, filing jointly. This means your first $31,500 of your income is tax-free. You don't pay any taxes until you get above that. Or if you're single, $15,750. So, for example, my son, when he was in high school, he had a job, but, he didn't make that much money. It was way below the standard deduction. So whatever he earned from his job, his taxes were zero because he didn't make more than $10,000 or whatever it was at that time. So that could be something to consider in terms of your planning situation. Now, one thing that hasn't changed under current law is that if you're 65 or older, or if you're legally blind, was that 20 over 200 or something like that? If you're legally blind, you get an extra $1,600 to your standard deduction. So if you're married filing jointly, it's $1,600 times 2 is $3,200. And if you're single, it's an extra $2,000. So you get a little bit of bump up for your standard deduction. That means lowering your taxes. All right, let's talk about this senior deduction. You guys heard about this, right? This is new. $6,000 senior deduction. The only thing you need to do is be over age 65. If you're 65 or older, you get an extra $6,000 senior deduction. If you're married filing jointly, if both of you are over 65, that's what, 6,000 times 2, that's $12,000. It doesn't matter if you itemize or not. It has nothing to do with Social Security, despite what you see in the media. So it has nothing to do with Social Security. And to get it, yes, you have to have a valid Social Security number. But you got to look out for is that it's based on your income limit. So you'll get the $6,000 deduction as long as your income is less than $150,000 for married filing jointly, $75,000 for unmarried. So that's something you got to look out for. So this was added because the president wanted to say no tax on Social Security. You cannot make any changes to the Social Security law under budget reconciliation. That's why you can't change Social Security under this law, because you have to do it the regular way with 60 votes in the Senate. So according to the IRS, they're saying that 64% of Americans aren't paying taxes on Social Security right now, and with this extra $6,000 deduction, they think that's going to bump that up to 88%. How many of you got this email from Social Security? I got it. This is actually mine, the one I got from them. And it's kind of misleading, which I wish they didn't do this. It says, Social Security applauds passage of legislation providing historic tax relief for seniors. Take a look at the second to last paragraph. It says, the new law includes a provision that eliminates federal income taxes on Social Security benefits for most beneficiaries. That is incorrect. So I wish Social Security didn't do that. And fortunately, there's some articles in the media to point this out saying this is a bit misleading. It's put up by the new Social Security administrator. He is a political appointee to the president. The previous administrator, she resigned because she refused to give the Social Security computer data to DOJ. Well, he did. So anyway, she resigned because of that, and he's a political appointee, and I wish he didn't do this. It's kind of misleading. It's not really correct. The senior deduction has nothing to do with Social Security. All it has to do is what's your income level and your age. That's all that matters. That's all that matters to this deduction. So what does this mean for financial planning purposes? Well, it depends on your situation, of course, but one consideration to think about is my Social Security claiming, right? We always get this question as planners. As planners, one of the questions we have for our clients have for us is, hey, Larry, when should I take my Social Security? I can take it at 62, should I? Or should I wait till I'm at full retirement age, which is currently, 67, if you're born 1960 or later? Or should I wait till the latest, at age 70? It stops increasing at 70. I know some people wait till they're 75 to claim Social Security because it can keep going. If you're still working, your Social Security benefit will increase. If I take it early, what's the downside of taking it early? I get a permanent discount, right? It could be up to a 30% discount. You take it early. And, so you're getting less in the long run. But maybe you need it, or maybe you'll die pretty soon, so you might want to take it sooner. So it all kind of depends on your situation there. But that's a planning consideration. If I take Social Security now, is it going to knock me out of the eligibility of that senior deduction? That's a good question. The other consideration is your required minimum distributions. Should I take it now? Should I delay it? It depends, right? So with the current law, if you're 73 or older, you have to take your required minimum distributions from your IRAs, your traditional IRAs, your 401ks, your retirement accounts that are not Roth accounts. Now, at age 73, you have a choice. You can take one required minimum distribution at age 73 and one at 74. Or you can take none at age 73 and two at age 74, with the first one by April 1st of the year you turn 74. So there's some planning decisions here, right? Because what if I took one distribution at age 63? That might make my income too high for the senior deduction. Or maybe it doesn't make a difference. Maybe I'll push it into at age 74. So there's some planning considerations to do, trying to take advantage of the senior deduction. So these are a couple of questions we have for financial planning. Let's review the standard deduction that we're talking about here. So let's assume your taxpayers are over 65 and their income's below the threshold. Look what the new standard deduction could be. Look how high it is. Single, you start at $15,750, you add $2,000 for being over 65, and another $6,000 for that senior deduction. That's $23,750. Head of household, $23,625 plus 2 plus 6, that's $31,625. Married filing jointly, $31,500 plus 32 plus 12. That's $46,700. So what that means is if you're married filing jointly, you're over 65, your income's below the threshold, the first $46,000 of your income is tax-free. Or it can help you lower what tax bracket you're in. So that's a pretty big deal. So most Americans, over 90% of Americans are claiming the standard deduction. Very few of us are claiming the itemized deductions. That's less than 10%. So that's the standard deduction. And let's see, personal exemptions were eliminated with the Tax and Jobs Act. That's permanent now, no more personal exemptions. The mortgage interest deduction, no real significant changes there. The Tax and Jobs Act lowered the deductible limit on a mortgage to $750,000 for mortgages you get after December 15th of 2017. So I know you really can't buy a house with a $750,000 mortgage here in San Francisco, but that's the way the law is. No change there. Also, what didn't change is there's no deduction for home equity interest. So no change there. It's still not deductible. What's coming in next year is be able to deduct PMI, private mortgage insurance. So that starts next year. So we haven't had that deduction for the last few years. However, from a planning standpoint, why pay PMI? Who does it benefit? It benefits the bank, right? Do you guys like benefiting the bank? They're not our friends. So real estate, I think real estate values are going up, and if you're paying down your mortgage, you might be able to get out of PMI. So take a look at the math. Take a look at the bank's rules for PMI. See if you can get that eliminated. And what's that going to save you? About $100 a month, $1,200, $120 a month, right? We can all use that money. So let's try to eliminate the PMI, even though it's deductible next year. Has not been deductible for the last few years. All right, SALT stands for state and local tax deduction. SALT, big deal here in San Francisco, right? Because we got property taxes, we got state income taxes, and since 2018, we can only deduct $10,000. $10,000 if you're single. How much for married? Yeah, $10,000. No difference between married and single. And it's been that way since 2018, and every year, certain members of Congress have been trying to change that. Well, we have a group of Congress members called the SALT Caucus. They're Republican Congress members from New York, New Jersey, and California. They've been pushing to increase the deduction for state and local taxes. I know we have some clients that pay $50,000 for property taxes. They only deduct 10. Or had someone who he owed $3.3 million to California. How much of that can he deduct? Yeah, $10,000. He was not happy about that. So with the One Big Beautiful Bill, that's been increased to $40,000 for singles and $40,000 for married filing jointly. That's what they settled on, and that takes into effect this year in 2025. So we can deduct up to $40,000 of your property taxes and your state income taxes. It's permanent. Is it permanent? No, it's not permanent. It expires in 2030, so it's not permanent. It expires in 2030. It goes up 1% a year, so we know next year is going to be $40,400. Now, not everybody's going to get this, right? Depends on what your income is. So you'll get the full $40,000 if your income is $500,000 or less. So at least we got that. Most of us probably get a little bigger deduction for our state and local taxes. The concern, again, is marriage penalty, because, a single person gets to deduct 40. How about married? How come we only get 40? Well, that's the way the law is. So probably we're going to see people itemizing again, because $40,000 at the single level is more than the standard deduction. So, for our single people, we might be itemizing again. So, for tax planning with this new SALT deduction, now if you have what's called a grantor trust, you have grandkids or whoever you want to set up trust for, instead of having one trust for 4 grandkids, which I think is really complicated, how about setting up one trust for each grandkid? Because by doing that, each trust can take advantage of this $40,000 SALT deduction. So just a consideration to think about. If you do have multiple grandkids or whoever you want to set up trust for, don't do it in one trust. Too complicated. It's easier to do a trust for each beneficiary. I'd highly recommend that. Okay, more individual provisions going on here. The Tax Cut and Jobs Act have changed what you can deduct for personal casualty and theft losses. So, your bike got stolen, your purse got stolen. Well, you can only deduct that if it's attributed to a federally declared disaster, such as the wildfires we've been having, unfortunately, the wildfires, tornadoes, hurricanes. Only if it's attributable to a federal disaster that you can deduct it for personal losses. So no change there. They did kind of broaden the definition of what's a disaster area. The change now includes gubernatorial declared disasters, because in some cases the governor might declare a disaster, but not the president. So that's been expanded a little bit of change there. But otherwise, if it's a personal loss, only if it's attributed to a federal disaster, like the wildfires. The miscellaneous deductions, so those are like your legal fees, our tax fees, financial planning fees, not deductible. It's permanent. I got to mention, since we're here in California, still deductible on your California taxes. California did not adopt the Tax and Jobs Act changes, so that's still deductible for California. Same thing with a personal loss. You can deduct it on your California return, but not in the federal return. Appeased limitation means that when your income is above a certain amount, you lost a portion of your itemized deductions. That was eliminated, but Congress has brought in some more limits. We'll talk about that in just a second here. Okay, this is a part where I tell people to say boo, okay? This is one of those provisions you go, boo, why did they do this? So I would say boo to this one. So if you're itemizing and you make charitable contributions starting next year, you can only deduct a portion that exceeds 0.5% of your adjusted gross income, right? So here's an example. Let's say your income's $200,000. You donate $10,000 to charity, so your deduction is reduced by 0.5% of the $200,000, so that's $1,000. You gave away $10,000, 10 minus 1 is $9,000. Boo, right? So even though I gave away 10, I can only deduct 9 in this example. So what does this mean to you? Well, if you're going to make some large charitable contributions, do it now. Do it in 2025. So I'm telling all the charities I know, all the nonprofits I volunteer with, say, you better put this in your newsletter. Let your donors know that you get the full deduction in 25, but you're not going to get the full deduction in 26. So you might want to front load your deductions this year. Okay? Okay? Hopefully we'll get some big donations this year because you're going to lose a portion of your charitable contribution. So that's not a lot of fun. The other thing is itemized deduction limitations. This is for people in the top tax bracket. If you're in a 37% bracket, you don't get a 37% benefit for your deductions. It's limited to 35%. So the way they did the math is your itemized deductions are reduced by 2/37 of the lesser of your itemized deductions or the amount of income that exceeds the 35% threshold. So I have an example here. Let's say your income's $1 million. Your itemized deductions are 10 plus 90, $100,000. And your taxable income would normally be 100 minus a million minus 100, that's 900,000. And for 2025, the top marginal rate threshold is $751,600. So if that's your situation, your itemized deductions can be reduced by the lesser of $5,405 or $8,022. So even though your Schedule A deductions come out to 100, well, we lose $5,405 of it. You can only deduct $94,595. Boo, right? So again, this is why if you want to take the charitable contributions, you want the full benefit of your itemized deductions, do it this year. So we got to do some math here, right? How much is our state and local tax deduction? What's our mortgage deduction? Maybe we got to make that December payment. Make your December payment before the end of the year. You might want to go to the bank to pay your mortgage so that interest gets posted on your Form 1098. So you might want to push as much itemized deductions into 2025 since you'll get the full deduction this year, not next year. So that's something to consider. So for charitable planning, front load your deductions this year. Otherwise, you're going to lose a portion of it. I'm a big fan of donor advised funds. They're sponsored by two different types of groups. One could be the commercial ones, like there's Schwab Charitable, Fidelity Charitable, the commercial ones, or the community foundations have it, the San Francisco Community Foundation, the Silicon Valley Community Foundation. I have mine with the Silicon Valley Community Foundation, and what the best way of using the donor advised fund is to transfer appreciated securities. Go through your portfolio, see which has the most gains. So instead of paying capital gains tax on those securities, roll it over to a donor advised fund, you get the deduction for the value. The stock market's at a high, let's take advantage of that before it goes down, right? So consider a donor advised fund. For those of you who are 70 and a half or older, highly, highly recommend making all your charitable contributions out of your IRA account, known as the Qualified Charitable Distribution, or QCD. That applies when you're 70 and a half. I'm a big fan of those. There's some real big benefits of it. The big benefits are if you're required to take RMDs, required minimum distributions, it fulfills your RMD. That's number one. Number two, if you have bases in your IRA, the taxable portion goes out first. So the non-taxable portion still stays in your account. So lots of advantages of that. The other consideration I would consider if you're 70 and a half or older is rolling over up to $54,000 of your IRA into a charitable gift annuity. And charitable gift annuities are sponsored by a lot of major charities like the Cancer Society, the Heart Association, all the universities have one. So I think it's a great way of reducing your required minimum distributions and also benefiting charity. So some good strategies we have with charitable planning here. All right, who loves gambling? This might help you quit gambling, all right? So there's some changes here. This snuck into the law. A lot of people didn't know about this. And then now they're finding out about it. So under current law, you can deduct gambling losses to the extent of your gambling winnings. And the way it gets reported in your tax return is you report the gross winnings on line 8B of Schedule 1. That says gambling winnings, right? Gross winnings, not the net. Don't do that. A lot of people have done that and they got in trouble with the IRS. So, I won 100, I lost 50, so I'll just report 50. No, you report 100, and the loss, where do you claim the gambling losses? Line 16 of Schedule A. That's where you claim your losses. It's below the line, not page 2 of Schedule 1. So under current law, I win 100, I lost 100, 100 minus 100 is 0. That's right now. Starting next year, you can only claim 90% of your losses. So, same example, I won 100, I lost 100, but I can only deduct 90. So even though you don't have the money, right? You lost the money, well, you still got to pay tax on 10%. In this case, $10,000. Maybe that'll help people stop gambling, right? So another way another reason people quit gambling is, a lot of people, you're over 65, you're paying Medicare premiums, right? If you're paying Medicare premiums, Part B and Part D, that's based on your adjusted gross income. Well, gambling winnings are in adjusted gross income. So I have a client who wins about 600 grand a year or so gambling, but he loses about 600 grand, so the net is 0. But I said, hey, where's your W-2Gs from the casinos and all that? He goes, I quit gambling because his Medicare premiums shot up by $400 a month. So I guess Medicare helped him stop gambling. Yay. So maybe this will stop people from gambling. There is a bill in Congress right now by a Nevada Congress member to repeal this change. Because she says, oh, I didn't see this. I didn't know about this. Well, you're supposed to read the law, right? What are you voting for? So anyway, we'll see what happens. This is going to kick in next year. We'll hear some more stories about the gambling loss limitations. All right, we're in Silicon Valley. And so a lot of people here are subject to the alternative minimum tax. So the concern I had for the last couple of years is that, oh no, the exemptions are going to drop if the tax on jobs expires. Well, it's made permanent so that the exemptions are still pretty high. It's $88,000 if you're single, $137,000 if you're married filing jointly. So for those of you who have incentive stock options, this gives us an opportunity to do some more tax planning with how many shares can I exercise? What's my break even? How many shares can I exercise without incurring alternative minimum tax? So most of us will probably not be paying AMT, alternative minimum tax. So that's made permanent in the law. Oh, by the way, when all these provisions, you see the word permanent. What does permanent mean? Not forever, okay? It doesn't mean forever. Permanent means until Congress changes it. That's what permanent means. So that's what we live on here. Okay, child tax credit. So currently it's at $2,000 per child, 17 and under. It was $1,000 before 2018. It got doubled with the Tax Cut and Jobs Act. And I know, was it 21? We saw a big increase in the child tax credit because of the American Rescue Plan. So the Democrats wanted to bring back the 2021 child tax credit, which was about $3,600 per kid, got prepayments and all that, but it got bumped up to $2,200. So it's a little bit of an increase starting in 25, a little bit of change there. Student loans, one law change was that if the student loan was given because of death or disability, it's tax-free, so that's made permanent. However, you got to be real careful about any loan forgiveness your students might have. There's some provisions that are taxable. There's some provisions that are tax-free. So we got to be careful about that. So some of the American Rescue Plan provisions have changed. Student loans. Student loans are going through some significant changes starting July 1st of 26. The bottom line is the amount that you can borrow is reduced. The other bottom line is don't expect loan forgiveness. You got to pay it back. That's the bottom line here. Grad students no longer have unlimited amounts they can borrow for grad school. So from a planning standpoint, let's try to avoid student loans. Let's not make the first thing you look at. I would make it the last thing you look at. What's the most important thing we should do for our students? Open a 529 plan, especially when they're born, right? Every time my clients have a kid, that's the first thing we do. Open a 529 plan. Get all your friends and relatives to contribute to it. Grandma, grandpa, that's the best gift you can give. That money grows tax-free for education. So I'm a big fan of that. Too many people, unfortunately, rely on student loans, and now we have the student loan crisis. But speaking of student loans, if you're an employer, you can reimburse your employees up to $5,250 for repaying student loans. They just need to provide proof that they paid the student loan, and it's tax-free to them, tax deductible by the employer. So it's a recruiting tool. Some companies do it, some companies don't. You don't have to provide this, but I think, when you're trying to pick an employer, it's like, hey, if they're going to help me pay off my student loans, I might pick that company instead of someone else. The big change is that it's adjusted for inflation starting in 27. So it's been at $5,250 for quite a while. So that's going up. Okay, estate tax. Boy, that has been giving us a lot of heartburn for the last couple of years because the Tax Cut and Jobs Act doubled the basic exemption from estate tax. And then we're afraid that was going to drop in half in 26, the so-called sunset, the cliff. So currently for 2025, you don't pay the estate tax unless you have more than $13,990,000. And in 2026, it goes up to $15 million. So for a married couple, no estate tax unless you have more than $30 million. And then it's adjusted for inflation thereafter. Now, the planning point here is that I know a lot of people were concerned about the exemption dropping. It's kind of easy to get to $7 million. You have a house, you got a brokerage account, the stock market's been going up, you have an IRA account, and before you know it, you got $7 million, then you might have to pay estate tax. What's the estate tax rate? It's 40%. So if you die with more than the exemption, that's what your estate's going to owe, is 40% of that. So the good news, most people don't have more than $15 million, so most Americans are probably not be paying estate tax. But the thing we got to look out for is review your estate plan. Has it been updated to all the changes in the tax laws? And is the estate plan you have, is it appropriate? So the big tip of the day is review your estate plan. Do you have an estate plan? That's the main question too, right? Are we taking advantage of revocable living trusts? Are we naming beneficiaries on our retirement accounts? That's really important too. Don't leave it blank. Or, we had a case last year. This guy named his girlfriend as a beneficiary of his 401k plan. They broke up in 1989. Then he just died. And guess who got his 401k plan? It's grown to $800,000. Guess who got the money? Her. So his kids sued to say, no, it should go to them, not her. He hasn't seen her since 1989. But hey, if you don't update your beneficiary designation, that's where the money's going to go. So make sure you update that. Don't leave it blank. Don't leave it blank. Because I see the forms and I go, well, who's this? It's like 2 wives ago. Well, you got to update to your current wife if that's who you want to give it to. Okay, so for estate planning, now that we know what the tax rates are, so if there's some irrevocable trusts that you're mentioning, we kind of know what the tax rates are now. Now we can plan distributions, who pays the tax, that's a consideration there. No more sunset that we were worried about. So take a look at your gifting strategies to kids, grandkids, or whoever. However, what's not changing is this concept called portability. Portability is for when you have a married couple, the first spouse passes away. And then you file a Form 706, an estate tax return, to port over the deceased spouse's unused exemption, and it gets added on top of the surviving spouse. So, for example, it's $13,990,000. Let's say the husband dies this year, and so we can add the $13,990,000 to the surviving spouse's exemption amount. I think it's pretty important because we don't know what the tax laws are going to look like in the future. We don't know what Congress is going to do. There's a good chance they can reduce the exemption amount. So this is a way of protecting the surviving spouse. So portability still exists, and a lot to talk about there. And the lifetime giving, so a lot of people give the annual exclusion for 2025, that's $19,000. You can give away up to $19,000 per donee, each kid, grandkid, or whoever, $19,000. We just got the announcement that for 26, it stays at $19,000. This is something I just learned last year because I never gave it much thought, But last year we had a tax court case where this grandpa gave a whole bunch of money to his grandkids. He gave them, whatever the exemption amount is. Let's say it's $18,000. He gave $18,000 to each grandkid, each kid, each nephew, niece, grandnephew, grandniece. He had a lot of them. Well, what do kids do nowadays? They either lose the check or they don't cash it, right? Well, the ones who cashed it, that's a gift. So that's okay because they took advantage of the annual exclusion. Well, the ones who didn't cash it, there was no gift. And let's say they cash it next year. Well, let's say grandma gives another $19,000 and both checks get cashed this year. So what does that mean? Uh-oh. Grandma has a taxable gift because we didn't take advantage of last year's exclusion because that grandkid didn't cash the check. So that's something we got to look out for, right? So how do we prevent this? Well, the thing about checks is you can always stop paying. The grandson says something stupid during Thanksgiving. It says, you call the bank and say, hey, can you stop paying this check number 1055, please? Because my grandkid says something stupid. So if you can cancel the check, it's not a gift until the kid cashes it. But if you do it via cashier's check or was it Venmo or one of those electronic things that you can't recall, then that's a completed gift. So I never thought about that until we saw this case last year. And so what happened was those uncashed checks was taxable at 40% each. Yeah, that estate got a pretty big bill. And I was like, who knew, right? So I learned something from that case. I'm reminding all of you. Make sure the kid, if you want the kid to have the money, make sure they cash the check. Or just do a Venmo. Or what's the other one? Venmo? Zelle? Zelle? Yeah, whatever, right? Huh? Just give them, well, yeah, but cash is hard to track. Checks are easier to check, right? You have canceled checks and all that. Yeah, cash is a different story. Yeah, or cars or whatever. All right, so some changes are made to 529 plans. I'm a big fan of 529s. I used it for my kids, right? And I used it to pay for college. I invested the money, and basically the stock market paid for my kids' college education. Now, here's the change. However, I'm not going to recommend it to you. Why? We're in California. California didn't adopt these changes. So the 529s have been expanded to include elementary, secondary, and homeschool expenses. It'll be tax-free on the federal level. You can use it for post-secondary credentialing, like CPA review, EA review, bar review, medical boards, or whatever licensing you need to do, or continue education. I got to take classes all the time, or I teach classes to professionals, continue education. But I'm not recommending here in California because if you do this here in California, you got to pay California tax plus the penalty. It's a 2.5% penalty. So there's been some changes in 529s, which I can't recommend to you. That we have the K-12 tuition up to $10,000 a year. Yeah, great, but you got to pay tax and penalty in California. There's that 529 to Roth rollover that was introduced a couple of years ago. Up to $35,000. You have leftover money in a 529. Can't do it in California. Well, you could do it in California, but it'll cost you tax and penalty. So be careful about what you see. You always have to ask the question, what about California? We're like, the sixth largest country in the world if we were our own country. So we have our own tax laws. It doesn't always agree with the federal tax laws. Okay, if you're not itemizing, we have a charitable contribution for non-itemizers. You probably saw this back in 2020 and 2021. It was $300 and $600 that you can deduct even though you're not itemizing. Well, it's $1,000 for singles, $2,000 for married filing jointly. If you don't itemize, you can claim this charitable contribution. But it's got to be in cash. Not non-cash, not your stuff to your used clothes or whatever. It's got to be a cash contribution. The substantiation rules still apply. And it's like, a client can say, hey, Larry, just put me down for $2,000. Okay, all right. Give me proof. Give me a canceled check. Give me a thank you letter from the charity. If it's more than $250, you have to get a thank you letter from the charity. And the thank you letter has to have that magic sentence that, in receipt of your gift, you didn't get anything in return, right? So that has to be on that letter to claim that deduction. You can't just make it up. So those rules still apply. This is permanent in the law. The Tax Cut and Jobs Act bumped up the contribution limit for cash contributions 60%. It would have dropped back to 50% if the law expired, so it's being extended to 60%. So let's say your income's $100,000, you can give up to $60,000 and be able to deduct the whole amount as a charitable contribution. If you give more than that, you have 5 years to carry over. So some planning to consider there for charitable contributions. Now, some of us have kids, right, in daycare. The dependent care plan, it's been $5,000 for many years. So they bumped up to, yay, $7,500. Is that going to cover daycare? Well, probably not, but it's a slight increase there. So those are individual changes. Now let's talk about business. So for business, we have something called the Qualified Business Income Deduction, QBI. So it's a free 20% deduction if you have qualified business income. That's made permanent. Ooh, I was sweating that we're going to lose that. No, it's permanent. So we still get that qualified business income deduction. You deduct that on line 13 of your 1040. Okay, I'm not going to really talk too much about this. These are international provisions. So if you own a business overseas, doesn't matter if you took the money or not. If your business overseas made money, you just got to pay tax on it. However, there's some breaks here where you pay a lower amount of tax. So it's the government's way of encouraging you to bring money back in the U.S. So I'm not going to go over this in too much detail. The big deal here in Silicon Valley is research and development. You can take a full deduction now. It was capitalized before. If it's done in the United States, you can take a full deductions for your research and development. As a result of that, I've been seeing a lot of ads in on the jobs trying to hire more people to do local research and development now that you can deduct it before you had to amortize it. However, if you're doing R&D overseas, you still got to spread it over 15 years. Retroactive provisions, what that means is you can go back. So starting in 22, 23, and 24, you have to capitalize your research and development. You can write off the whole amount now. So you have a choice. You can go back, amend those returns, and get a refund, or you can deduct the remaining amount in 25 or spread over 25 and 26, research and development. Bonus depreciation is 100% now. It was 40% at the beginning of the year. Now, this only applies for new equipment you buy after January 19th of this year. So that's a nice change there. 179 expenses, that's when you buy business equipment. The limit was $1,250,000. Now you can do up to $2.5 million. So these are trying to help business invest more in their businesses. So that's what's doing here. So we saw some stuff there. We have a new code section for qualified production property. If you build a factory, normally if you build a building, you can't deduct the whole amount. You have to depreciate over 39 years. Well, if you're building a factory in the United States for building stuff, you get a 100% deduction. So this is new. Let's talk about business meals. Business meals. So who gets the 100% business meal deduction? Who gets that? Well, let's read this here. It's for meals provided on certain maritime vessels, fishing vessels, fish processing vessels, and fish tender vessels. You hear the word fish, right? Fish. Meals served at fish processing facilities located in remote, isolated northern areas of the United States. You have to be located north of the 50th parallel and outside of any metropolitan statistical area. What are we talking about? Alaska, right? Yeah, Alaska, right? So in between Alaska and the continental United States is Canada. So who's not above the 50th parallel? Maine. So the lobster fishermen did not get this break, but the Alaska fishermen did. And who's the Alaska senator? Lisa Murkowski. This is how they got her to vote yes, because she was leaning no. So if she said no, this bill would have died. We wouldn't have this law we're talking about today. So she got this for her people. So this starts next year. So if you're an Alaska fisherman in Alaska, you get 100% meal deduction. So this law starts next year for office snacks. So, we're here in the Bay Area. A lot of companies give free lunch, free dinner, free breakfast, and all that to their employees. And they've been fighting about this for many years. Well, to deduct the cost of those meals, you have to include that on the employee's W-2. This starts next year. So, office snacks, coffee. Have you been to some of these offices? Oh my goodness, there's a whole wall of cereal there. Or there's like a robot coffee machine. It's pretty amazing. So, however, there's 2 existing code sections that still apply. Code section 119 and code section 132E. So 119 is when employers require the employees to eat their meals at their premises at their convenience. You can't leave. Just think of your firemen. Think of your guys who work on a submarine. They can't leave, right? So we're going to provide meals for you. It's at the convenience of the employer. We had a case a few years ago, one of the sports teams. The players were not eating well. They ate a lot of junk, and they kept losing. So they said, no, you're having your meals with us. We have a dietitian, a chef, and it also builds team morale and all that. And also we're going to do that on the road. Well, they won that case. So Steve Kerr, is not him, it's a Boston team. But Steve Kerr, if you know, the Warriors, they all eat together. He says, you guys are all going to eat together because we have a dietitian, and we want you to eat well so you perform. So that was convinced the IRS that's convenience of the employer. In my office, tax season, we have to work Saturdays, right? So since I forced my people to come on Saturdays, I always buy lunch, convenience of the employer, because if they can have lunch in the office, they get out of there sooner. So that works for me. The other one's a de minimis fringe benefit, small, inconsequential, coffee, donuts, that's okay, right? Occasional overtime, that's okay, not the full-on kind of things. Also includes restaurant staff, the wait staff and the kitchen staff. So no 100% deduction for meals and beverages that you give to your employees. So the only exception are Alaska fishermen and restaurant workers. Those are the only 2 exceptions to get the 100% deduction. But what's still deductible? Well, you can have a holiday party, right? Picnics, customer appreciation events, client appreciation events. A lot of financial planners do that. So those are still 100% deductible. So if you go to one of those presentations where they provide you a meal, go to the Morton Steakhouse, come here and talk about financial planning. Well, that's 100% deductible. Business meals are still 50% deductible. That's taking customers, potential customers, recruits, or a business purpose. I had an audit a few years ago, and this guy included in his business meals his dinners with his wife. And he said, well, she's my employee, and Larry, we only talk shop. I said, nah, that's not going to work, right? She's your wife. You have a personal relationship. Oh, no, we don't. I don't know. I just got subpoenaed the other day from her lawyer, a family law lawyer, so they really were only talking shop. Okay, all right. So more business provisions here. So for many of us who are getting Form 1099-Ks, they bumped up the amount to $20,000. It used to be $600. If you are getting 1099s, now the threshold's $2,000 when you have issued 1099s. Excess business losses. Only reason I have it in here is because the House version is going to make it a separate category, which in some cases you will never get to deduct that. And hopefully we don't have to deal with excess business losses because you're going to make money, right? So we're not going to have to deal with that. Business charitable contributions. We talked about the haircut, the 0.5% adjusted gross income haircut for individuals. For business, it's 1%. And a lot of our business clients are single shareholder, they're small corporation. I said, well, give it personally, not through your corporation. Why? What's the corporate tax rate? It's 21%. What's the personal tax rate? 35%. So you get better deduction if you do it personally instead of through your corporation. Farms, a new break for farms. If you sell a farm, you can pay the taxes over 4 years. It's got to be a farm for the last 10 years. And the hard part about this is it's got to be a farm for the next 10 years. Who knows about that? So that's that. There's this new money accounts for growth and advancement. That used to be called MAGA accounts. Now they're called Trump accounts. Trump accounts, our favorite president. Yeah, I know. Our new code section 530A. Oh, there's a typo there. It should say 18. So it's a new tax favor account for kids under 18. And parents can put up to $5,000 a year into the account. They can't take the money out until they're 18 or older. We can only use for 3 purposes: college, first-time purchase of a home, or starting a business. And when you take money out, it's not tax-free, but it's taxed at capital gains rates. And you get a $1,000 deposit into the account if you have a child born between December 31st of 24 and January 1st of 29. Now, the Trump accounts are run by the federal government. Yay, how do you feel about that? It's going to be run by the U.S. Treasury. Yay. Okay, so you can't go to your bank to open a Trump account or Fidelity or Schwab. It's going to be a government account. The kid's got to be a U.S. citizen. At least one parent has to have a social security number. And it's invested in mutual funds that track the U.S. equity index, so the S&P 500. So at 18, the child can take up to half of the account for those 3 purposes. At 25, they can empty the account they want to. At age 30, they can use the money for any purpose. Or you can leave the money in there forever. It just gets taxed at the capital gains rates. This doesn't start until July 4th of 26. So I've got a lot of questions about these, but we don't have any details yet. So we'll hopefully get some details before July 4th of 26. So you can't run out there and buy it. Now, as an employer, there's a new employee benefit, Section 128, which the employer can put $2,500 into an employee's Trump account per employee, not per child. So you might have an employee with 1 kid or an employee with 8 kids. Well, it's the same $2,500. You can't discriminate. And it's got to be part of a plan. So that will start next year. And also, there'll be a code in your W-2 for this on next year's W-2. Okay, have you heard a lot about this no tax on tips, right? No tax on tips. So the maximum is $25,000. It's for people who are employees, W-2, 1099 NEC, 1099Ks, 4137. So the 1099 NEC and 1099Ks, those are your gig workers, right? Like I just took a ride on Lyft. I always tip the person, So that could be deducted for no tax on tips. So if you're a gig driver, and I had a tax planning session with one of my drivers last week. I said, yeah, make sure you go to Lyft now. Go to your website, print out the report. It'll reconcile to your 1099s, how you got paid. There should be a line there that says how much you got in tips. That's the amount that you can deduct, up to $25,000. It's temporary. It goes from 25 to 28. There's like 13 pages of occupations that qualify for this. However, there's an income limit. If you're single, it's $150,000. If you're married, it's $300,000. If your income's above those amounts, you don't get the full deduction for no tax on tips. So we're supposed to get an official list by October 2nd, but what happened on October 2nd? The government shut down, right? So we don't have an official list. But we'll go over that in a second here a little later. Now we have this no tax on overtime. A lot of questions about that, right? The most you can claim is $12,500 if you're single, and $25,000 if you're married. Same income limits, right? $150K for singles, $300 for married. And it's also temporary. And we're going to go over the form that reports this. We have a new tax form. Here's what the tricky thing is. It's only if you get qualified overtime. What's qualified overtime? It's got to be overtime compensation under the Fair Labor Standards Act, Section 7. Who's not covered by that? Our union workers, right? And those things like that. If you have a shift differential, that's not overtime. If you get bonuses, you get commissions, that's not overtime. So I know there's a lot of questions about that, and a lot of people are not too happy that they're not included in this. A lot of people are salaried. They don't get overtime, right? So, and what's the deduction? Not the overtime amount. It's the difference between your overtime and your regular pay. So here's an example. If you make $20 an hour, you get $30 an hour for overtime. It's the 30 minus 20, the $10 an hour. That's your deduction. So check out this fun calculation we're going to have to figure out this tax season. So let's say you got someone who works 50 hours a week, and he makes $22 an hour. And let's say he works 50 weeks out of the year, he gets a couple of weeks off. So $22 an hour times 40 times 50 is $44,000. His overtime is $33 an hour times 10 times 50, that's $16,500. His W-2 would be $60,500. What's his overtime deduction? No, it's not the 16.5. It's going to be the 33 minus 22 times 10 times 50 equals 5,500. So he'll save about $660. Who's going to have to figure this out this year? Your tax professional. So you would have to get the year-end pay stub. Now, it's going to get tricky, right? What if I start the year at $22 an hour and then I get a raise to 25? Well, we got to do the calculation. There's going to be some math you have to figure out. The company's not going to do this for you. So hopefully in 26, they get the computers programmed to do this for us next year. But they're not doing it for us this year. So it won't be on the W-2. We'll have to figure it out. Oh, is that going to be fun? So I've been teaching this to the tax professionals, and they just groan at this, right? So first of all, the thing is, so I've been getting emails from the tax people saying, Larry, my client works for the union. Can he take advantage of this? My official answer is say, I can't answer that because I'm a tax pro, but I'm not a labor lawyer. I can't comment on the Fair Labor Standards Act because that's not my jurisdiction. That's not my specialty. So we might have to consult a labor lawyer who practices in the Fair Labor Standards Act. Oh, this is so much fun. Then we have the no taxes on car loan interest. So you can deduct up to $10,000 for car loan interest. It's got to be a car assembled in the United States. New car, no RVs, no campers. It's got to be less than 14,000 pounds. Under 14,000 pounds, $10,000. And there's your income limits, $100,000 for singles, $200,000 for married filing jointly. All right, let's go over a case study here. We got Andy and Megan. They were married in 25. They're both over 65. And I made up these numbers to make it fit our scenario here. Their modified adjusted gross income is $150K. He got $50K in overtime. She got $30K in tips from her waitress job. He bought a car. He paid $12,000 of interest. So what's his standard deduction? What can he claim, right? And they have 2 kids under 17. So let's do the math here. So standard deduction starts at $31,500. Over 65, that's plus $3,200, plus $12,000 for the senior deduction, up to $25,000 for the no tax and overtime, $25,000 for no tax and tips, $10,000 for the no tax and car loan interest. Look at this, $106,700. What a deal, right? So the first $106,000 of his income is tax-free. It would have been $33,000 before all these law changes. And for the kids, they get an extra $400. So you know who Andy and Megan is, right? You know them, right? Well, Andy is single and 26. Andy was with some other women on that kiss cam at the Coldplay concert. That's yeah. I made that up. So anyway, he's single and 26. So, that's what happens when you're hugging another woman. Anyway, look what happens. He's single now. He only gets a $16,000 standard deduction. He gets a $22,000 65 bonus. So he's only getting an $18,000 deduction versus $106,000. She got the kids, so he doesn't get the child tax credit. Pretty big difference, right? Okay. Other new provisions here, we get this employer-provided child care credit. So if you have a business and you provide daycare or you pay for a daycare center or whatever, you can get a pretty good tax credit for that. It could be up to $600,000. So something to look at. The reason they bumped up this provision is to help people get to work, right? Daycare is always a big deal. So that's worth considering. We have a new SGO, Scholarship Granting Organization. This doesn't start till 27, so I'm not going to go into this too much here, but you get a tax credit for donating to certain scholarship granting organizations. Opportunity zones. So we've had this since 2019, and it's a way of deferring your capital gain. It doesn't matter if it's short-term or long-term, into a qualified opportunity zone investment. And so if any of you taken advantage of it, it defers the capital gains tax to 2026. So there's so some people might have to pay some capital gains tax. So it expires at the end of this year, expires at the end of 25. We have a gap year, so 26, there's no new opportunity zone funds we can take advantage of. It starts again in 2027. So they're fixing the definitions of what's a qualified opportunity zone. There's some around here if you look at the map, but it's to help impoverished communities, invest in the real estate there. So we have this new qualified rural opportunity fund starting in 27. So if you hold it for at least 5 years, your basis in the fund goes up 10%. If it's a rural opportunity fund, it goes up 30%. If you hold it for 10 years, you get 100% step up in basis. So that's part of the planning here, is to get people to invest in certain impoverished areas. We're in Silicon Valley. The hot topic we have here is qualified small business stock, QSBS 1202. If you either invest in a company, qualified small business, you can exclude up to $10 million a gain as long as you hold it for at least 5 years. Well, that's being bumped up to $15 million. And the definition of a qualified small business is now $75 million. It used to be $50 million. So these are for our startups. So if you work for a startup, you might want to consider exercising your stock options if you work for a startup company. Or if you're an investor or you have a business, it might make sense to consider this. Now, what other changes, instead of holding it just for 5 years, if you hold it for 3 years, you exclude 50% of the gain, or 75% of the gain if you hold it for 4 years. So this is a real big deal, especially around here. So we have a lot of people who specialize in this area. So how are we paying for this? Well, there's some changes to Medicaid, which we've been hearing a lot about in the news, right? So this is a bit controversial, but some of these provisions start in 27 and 28, the work requirement and the more frequent check-ins. The electric vehicle credits have expired. Too late now. That ended on September 30th, so no more tax credits for buying electric cars. However, we still got the energy efficient home improvement credit. That ends on December 31st. If you want to get insulation for your house, windows, doors, heat pumps, those kind of things. That ends on December 31st. Solar panels, windmills, geothermal, that 30% credit, that ends on December 31st. If you want that, you better do it now, because I have no idea how busy the contractors are, or if they even have the supplies. So if you want it, you better do it now. And you're probably seeing those commercials too about this expiration of the credit. So if you want those credits, do it now. Some changes to the health savings accounts. Now, bronze and catastrophic plans under the covered California qualifies for HSA, so that's great. Concierge medical. Some of us pay a monthly fee to a doctor to see a doctor as much as we want. Now that's included in health savings accounts, and also telehealth. We learned a lot about that during the pandemic. There are more provisions that I would love to have seen. I left it here, I put lines through it, so these didn't pass. You can't add to an HSA if you're on Medicare. They would have given an exception for Part A. You can use your HSA money for fitness expenses. They took that out too. So there's some, I left it in here in case you talk to your Congress member and say, hey, look, these are pretty good things. Consider putting them back in there. The employee retention credit, stricter enforcement on that, so that's basically ended. There's a new excise tax on remittance transfers. You send money overseas, 1% excise tax. But if you're working with a remittance company, make sure you're verified that's coming from exempt sources so you don't pay that. So I've been seeing some commercials on TV. I think it was for Wise, I think. Is it Wise? Well, one of these companies. So make sure it's coming from an exempt source if you're doing any remittance transfers. Okay. So what's next here? Well, we got a shutdown. So hopefully they get their act together and pass the budget, right? 12 appropriation bills. That's what they got to do, and they don't seem to be moving very quick on that one. So we're past September 30th. So we'll see what's going to happen with that. We need a lot of guidance. We have all these changes here. We don't know we have a lot of questions, right? A lot of questions. So awaiting some guidance. There's the Fair Bet Act, the Fair Accounting for Income Realized from Betting Earnings Taxation Act. Dina Titus of Nevada says, hey, we should repeal that, right? That gambling one. And look at what Marjorie Taylor Greene's got. No Tax on Home Sales Act. Right now, a lot of us are paying taxes when we sell a home. And by making no tax on home sales, we'll hopefully goose up the real estate market so that can move. I think be kind to your tax professionals. Be very kind to your tax professionals. I recommend talking to them now to see how this affects you personally, right? You do it now. Don't wait till tax season. Talk to your tax pro now. What does this mean? What can I do? What should I do? It's going to be a tough tax season, so be kind to them. Be kind to them. Are we going to get our forms? I don't know. The IRS, the government shut down, right? So our software vendors going to be able to get the programs updated. So it's going to be an interesting thing of what's going to happen. Let's go over some new forms. So Schedule 1A are those new deductions called additional deductions. So it's Schedule 1A. Part 1, what's modified adjusted gross income? That's line 11 of your tax return. The adjustments are pretty obscure. Most of us don't have them. Most of us don't have income from Puerto Rico or American Samoa or foreign earned income exclusion or foreign housing. So basically, that's your MAGI, your modified adjusted gross income. Part 2 is no tax on tips. Take a look at the middle. It says, if married, you must file jointly. So you can't file separately. You're not going to get this deduction. So no tax on tips, that's part 2. And then part 3 is no tax on overtime. Same thing. If you're married, you must file jointly, and you have to have a Social Security number. No more ITINs. And then part 4 is no tax on car loan interest. Look at this. They want your VIN number of the car you buy. So you got to input the VIN number. Also, if you're deducting your car loan interest on your tax return for business, Schedule C, Schedule E, or Schedule F, you got to take that out. You can't double dip. And then part 5, enhanced deduction for senior. That's a $6,000 deduction there. Same thing. If married, you must file jointly. So this is Schedule 1A. I thought it was going to be Schedule 4, but because these are temporary, that's why it's called Schedule 1A. And then you add them up, it goes to line 13B of your 1040. No change to the 25 W-2, but next year, here's a picture of the 26 W-2. We got this new box here. This is 14B, Treasury Tipped Occupation Code. So if you get tipped income, that's the code. And then box 12 is where you have all the details to the numbers. So I think we're pretty familiar with the existing codes on your W-2, but I'm going to point out the new ones. The new ones are TA, which is employer contribution to your Trump account. TT is total amount of qualified tips. So this is for next year. The company, your employer is going to calculate that for you, not for this year. And then TT is the amount of qualified overtime compensation. So hopefully the computers get updated to calculate that for us. So those are the new codes in your W-2. Schedule A, I think the biggest change I see is line 5E here, where it bumps up the SALT deduction limit from $10,000 to $40,000. So that's a change on Schedule A. And then here's the new 1040 for 2025. Look at all the new boxes they have. Oh my goodness. So yeah, there's a lot of new boxes here. I'm going to point in the middle here. Digital assets, cryptocurrency, NFTs. Look where it is. It says, at any time did you receive, sell, exchange, or dispose of a digital asset? That's what cryptocurrency and those things. Where do they put this line? Above your kids. Your kids go below that. So cryptocurrency is more important than your kids. You notice we still have head of household. We almost lost that. In the House version of the bill, they were going to get rid of head of household status because there's a lot of fraud with that. So, but the Senate brought it back. And all kinds of boxes here about who lived with who and all that kind of stuff. Okay, on the line 4, IRA distributions, we got some new boxes here. We got a rollover box and then QCD. Yay, we got a box for QCD, so that's great. And then line 5 is for pensions and annuities. We got a box here for PSO. Those are for public safety officers. If you're a retired police officer, firefighter, sheriff, you get a $3,000 deduction off the top of your retirement pay for medical expenses. So those are new boxes we have this year. This is the back of the 1040. So we have a new line 13B. Those are for those additional deductions. So that's new. And then, let's see, under refund, you notice the refund part? No more paper checks. No more paper checks. You have to get a refund, direct deposit to your bank account. So you put in your routing number and your account number. The IRS already knows your bank account, so, right? So people say, oh, I don't want to give them my account number. They already know. So put it on the return. Don't forget about that. There's these boxes on the lower right corner for IP PIN, identity protection PIN. If you're concerned about identity theft, you might want to sign up for an IP PIN. You input those numbers there, the IRS knows this is your legit tax return. So that's if you want to apply for that, I think it might be a good idea. The next 13 pages are the occupations that qualify for this tips. You know, the first one's bartenders, wait staff. So you can take a look at this list here of all the different people who would qualify for no tax on tips. And if you have any comments, you got till October 3rd to tell the IRS that, hey, you forgot about me, you know, if there's an occupation or there's the left-hand column is the occupation codes. Okay, we got that. And then the next few pages, because I can't remember all these tax changes, are the dates. So this is the retroactive ones. This is for 25. So these are the changes happening in 25. These are the change. Oops. This is January 19th of 25, July 4th of 25, 26. So these are changes that are kicking in 26, 27. And then the phase outs, you know, the income limits and all that. I can't remember all those, so I put them all here on one page. Okay, so resources, but the most helpful ones on the bottom here, One Big Beautiful Act of 2025 tax provisions. Those are the FAQs from the IRS. Actually, they just updated it on October 15th, so very helpful there. They're always giving us more information as we're getting more guidance from them. And I think these are some resources here. And Jonathan, this takes us to the end of the slide deck. Okay, so we have a few minutes for Q&A, right?
Thank you so much, Larry. So if you have a question in the audience, raise your hand, and my colleague here will bring the microphone over. I'm going to be jumping in with some questions from our Zoom audience.
Okay, well, I know we had a young man in front that had some questions, but I think he's not here. Okay, all right. Okay, great.
Hi, I essentially have questions about IRA conversions.
About what?
IRA conversions from.
Oh, you're talking about Roth conversions?
Right.
Okay.
From a 403B to a Roth IRA.
Okay.
Yes, can you explain
That's
it?
kind of off today's topic, but last year we did an Everything Roth IRA seminar. We can always do it again, right, Jonathan?
Do you
Yeah.
have the paperwork on that?
Okay, well, I'll hang around. We'll talk later.
The library has a recording of that program.
It's on the YouTube. Yeah.
We can talk to you about that.
Okay. Yeah.
So a question from the Zoom webinar. Isn't the $2,000 non-itemizing contribution not available until 2026?
You're talking about the non-itemizer deduction? Yeah, that starts in 26. So it's $1,000 for singles, $2,000 for married filing jointly. Cash contributions only.
Okay. The next question from Zoom. Will 2025 charitable contributions carryovers to 2026 be subject to the floor?
That's a good question. So if you give more than 60% of cash contributions, you can deduct up to 60%, then that gets carried over for 5 years. If you give appreciated securities like stocks, mutual funds, and all that, the limit is 30% of your adjusted gross income. So you got to do some careful math there. That gets carried over to next year. Then the question is, are we subject to a haircut? Yes, we are. So it's basically 0.5% of your adjusted gross income, whatever your charitable contributions are, current, past, or whatever. But we'll get more guidance next year. Yeah, there's someone over there.
Hi, can you review the overtime thing? Did you say that if you have a job where you're under a union contract, that the benefit for
Yeah,
not
it's,
being
it's
taxed
under
on
the
overtime
Fair
doesn't-
Labor Standards Act, Section 7. So it depends on your job and if it's, what do they call that? What's a union job called? It's collective bargaining and all those kind of things. So it's a bit complicated with that. So, it's Section 7 of the Fair Labor Standards Act. If you're getting qualified overtime, then you get the deduction. If you're not having qualified income, then no, under current law. I'm not a labor lawyer, so I can't really answer that, right? So we'll have to check with a labor lawyer on what the right number is. So there's certain things we're not really qualified to answer because that's not our jurisdiction.
Okay, another question from the Zoom webinar. Just to clarify, the estate tax exemption of approximately $14 million is not expiring this year, but increasing and not impacted by the shutdown.
The shutdown has nothing to do with the tax law. And by the way, the people who their job is to implement the new tax law, to design the forms, to program the computers, to run the computers, to process tax returns, to process refunds, those people are still working. Not being paid, but they're still working. That's over half of the IRS. 43% of the IRS is furloughed. And then there's a bunch of them who are fired. So we'll see what happens with all that. Then they're shorthanded, so they're trying to hire people again because they found out too many people have left. Yeah. There.
Hi, can you speak about people who have jobs, they live in another state and they travel in to California for work, for like a contract? Are you able to speak about that?
Okay, I can't hear you. Say a little louder.
Can you speak about, say, someone travels in for a contract?
Oh, you're talking about traveling workers.
Traveling workers,
Okay,
yes.
so that doesn't have anything to do with federal tax because you're taxed on it no matter what.
Okay.
So the issue is state taxes. And that gets a whole bit complicated, right? Because you might have to pay taxes in the states you're working in. It depends on your state of residence. So that's a pretty complex question. So it's kind of beyond the scope of our discussion today. But we can talk about it individually if you want to.
Okay, one last question from the Zoom webinar. Are out-of-pocket dental expenses deductible?
Out-of-pocket dental expenses, right? That's Schedule A. We showed you Schedule A. So that includes all your medical expenses. That includes the insurance you paid for, out-of-pocket medical, including dental expenses, co-pays for prescriptions, and anything else that's not covered. And you add that up, the amount that exceeds 7.5% of your adjusted gross income is a deductible medical deduction. And if your itemized deductions are more than your standard deduction, then you get to claim that. Now, if it's less than your standard deduction, you claim your standard deduction. Yeah.
Just, can you recap the car loan deduction?
Okay, so starting this year, this is only for new cars that you bought in 2025, and it's got to weigh less than 14,000 pounds. So what's a 14,000-pound car? It's those blue Amazon trucks you see cruising around. That's a 14,000-pound vehicle. So if it's smaller than that, it's probably going to qualify. It's got to be a car. It could be a motorcycle, but no RVs or campers. But it's got to be a new loan that you get in 2025. So you can't refinance an existing loan. And the amount of interest you can deduct above the line, subject to your adjusted gross income, is $10,000. And you got to put the VIN number down. So, yeah, it's a good question, right? How much should I put down for the car? Cars are expensive, aren't they? Yeah, but it's got to be a new car, not a used car.
So related to her question, is there a sunset date for that? Like, does it expire a certain year?
I don't have it memorized. I think so. There's an expiration date. I forget what it is. It's on the chart.
And then also,
I don't think it's not permanent. I think it expires in 28, right? It's on the chart.
and it could be any car, not necessarily U.S.
U.S. assembled vehicle.
Oh, U.S. assembled.
Yeah.
vehicle. Okay. And then my question, sorry, has to do with the child tax credit. I missed the slide. What changes are there with the child tax credit?
The child tax credit is being increased from $2,000 to $2,200. And it's for children under 17. So once they're over 17, you get the other dependent credit, that's only $500. So there's no change there. All right, we're at the end of time, Jonathan.
Yeah, thank you so much, Larry. As always, you give a
All right, well,
great
thank you, everybody,
presentation.
and we'll see you again.